Anyway, thank you all for coming. I've been in the games field for 35 years. I started as a game designer, but more relevantly to those of you who come over here for the last 13 years, whether as an advisor or a board member, I've worked with early stage to later stage companies. I'm currently working on some of the acquisition. There's a list of companies I've worked with in my bio if you're curious. Some of the recent sales were Playdom to Disney for about a list price of 700 million. PlaySpan to Visa for about 200 million, and Wireless Generation to News Corp for about 300 million. Um, Unfortunately, I haven't got any billion-dollar ones, but I'll try and get a billion from Dan later at the end of the session. In any event, last year we did a summary of where the money was coming into games, and this is the third of three presentations I've done at Casual Connect Europe last year, Casual Connect US, and now this one. The first one was about the five main investors and acquirers in the space, and those are the strategics, who now are 40% of the money going into the field, with a particular reference to Asian companies. Asia is now the epicenter of game finance. Then the superangels, then the institutional venture capitalists, who have largely run away from this field. We'll talk about that in a moment. And lastly, government financing, which in Europe is a huge, which is a huge amount of money. And in fact, we will have the head of the EU Commission who handles it coming later today. If you are curious to find out what motivates each of these categories, I did a talk in the US on the drivers for investment in August, which you can find on by looking under Casual Connect in my name for the August presentation. So what triggers investment acquisition? We're going to start by talking about not how you dress up your company for sale, which is what most of the presentations are about, but why the people on the other end will actually pull the trigger. That is, either offer an investment or offer to buy your company. The first one is always need. They have a business need. I need to get someone who does puzzle games. Fear of missing out. Everyone else is investing in virtual reality. We have to have our own virtual reality play. And the other one is put money to work. Investors often have limited partners who give them money and who expect them to put that money to work because otherwise they won't be able to get a return, a good rate of return on their money that will beat putting it into a safe instrument like a stock market, like a certificate of deposit or a bond. The most common advice in interviewing people for this session, which includes some of the top VCs in games and some of the top acquirers, it was don't call us, we'll call you. In other words, most of the investments get made are when people come looking for a type of company or specifically for your company as one of the first names that they acquire. There is also the issue of opportunity aligned with timing. One of the issues with these guys, with VCs, with angels, with heads of corporate development for companies, is they are in the business, they have to always know what the good deals are out there. So they will talk to everybody. But to give you an idea, as one venture firm I worked with, Polaris Partners in Boston, which is $1 billion fund, said, we turn down 98% of the deals we look at. That ratio is unfortunately the one that applies. Corporate investors may only turn down 90% of the deals that they look at, but the VCs tell us that's because they're lazy and that they get paid a salary, so they don't have to actually look at as many as the VCs do. The next thing that brings it, which I hope does not apply to any of you, is a fire sale. A fire sale is a polite way of saying you're running out of money, you desperately have to sell, and the VC and someone can acquire you cheap. So that's the reason why somebody comes to the table. And the last, which is the rarest and most wonderful situation, which I hope many of you will have an opportunity, is when someone says, I have to buy a that, and your company is the that I want to buy. Often this is with a company where there is the CEO or the CEO is also the founder. And it is a rare and wonderful thing when it happens. It also, the second most often time it happens is when there is a new hotshot who comes in, a new partner or a new head of corporate development who is given a chance in his or her first year to make a deal, and you happen to be the lucky person that they've decided to be able to invest. Um, and if you have one of those, God bless you. It's wonderful. It's not going to happen again in all likelihood, so enjoy it while you can. Okay, so let's talk about what happens from the side of the table, the people with the money. So at the beginning of the process, it only happens that someone comes into a discussion. You're optimistic. We just had a great meeting with Google Ventures. They're happy to talk to us. We just had a great meeting with Gameforce. They're happy to talk to us. The only reason why these people are coming to the table with you is because they think that you could be a great deal once you've gotten past the first fielder. So there's wonderful optimism. Everyone, your company's great. They're a wonderful investor. They're a wonderful buyer. But once they become serious, people start doing the analysis to the downside risk. So all of a sudden, the person who told you you had the bluest eyes and the most wonderful game company is now in the business of deciding how you can screw up and how the deal is not going to work. And they do that because, among other things, it's good. They are in the business of risk assessment, so they have to figure out whether or not this is a risk that the company can take in terms of, or the fund can take in terms of deploying its capital. And they also have to decide, can things go wrong? That's due diligence and so on and so forth. Often, the game studio or the game company does not realize that the person who was telling them how wonderful they were and they hoped to have an opportunity to buy or invest in them is now in the business of trying to find out everything that's wrong with you. And missing this shift is often the reason why a lot of people is often where deals get lost. If the best thing that you can do is anticipate that if someone is serious, they have to do this. It's part of their fiduciary duty. It's part of what they have to do as a matter of business. So trying to figure out how they're going to see your company's going to fail. For example, if your first game is a hit, the obvious risk is that it could fall off a cliff or your second game could be a dud. That's an obvious risk that somebody has to assess. So a lot of investors say, if I'm investing in a company, I want to know about their second and third game. But these are the sorts of things that you will do better if you are anticipating that they have to go through this process if they're serious about you. And the standard compromises are the valuation. In other words, they may say, well, we're really making an offer, but it's not quite as good as you had hoped. And with an acquisition, if you say you're going to do 100 million on your next game, they say that's great, but let's make most of the money that you're going to get dependent on getting to 100 million with percentage payouts up, at 80 million, 60 million, 40 million, etc. So, let's talk about the macro investment realities. That's what, the larger investments. So the game sector is out of fashion with the institutional venture firms. These are people who are investing $3 to $5 million, let alone a Series B, which may be larger. In Europe, they have pretty much, with one exception, they pretty much all run away from it. So Axel, which is perhaps one of the two most successful venture firms, has not made a big games investment in 3 or 4 years. They have a great record. They invested in the Supercell Series A. They invested in Playfish, which was sold to Electronic Arts for $400 million. They've invested in Gameforge, which hasn't been sold, but is a company worth many hundreds of millions. They have only one big failure. This is a record that other VCs would kill for. But since investing in Flare Games, which was the second company by one of the co-founders of Gameforge, they have not made, or at least they have not announced another one. Index Ventures, which is the only institutional that was in both Supercell and King.com, has a fairly full plate, and they are apparently the one exception. But for the most part, institutional venture firms have decided that the game sector is not interesting to them right now. One reason is that the upside is capped. When you get over $500 million, the game companies generally get about 1.5 to 2 times their trailing 12 months revenues or their projected next 12 months revenues. This is lower than most other software fields. So this is one reason why King.com went out in the stock market with a valuation of $7 billion and got sold for $5 billion. It's a fabulous result. But if they were an enterprise software company, they would have gotten a better valuation. So also in the U.S., the all the Silicon Valley guys are pretty much on the sidelines too. There are a couple of exceptions, and I can name them. Mitch Lasky of Benchmark will always do one investment in this field. Phil Sanderson of IDG may do an investment, but literally the fact that I can name three or four of them and that's it tells you something. However, the good news is the strategics, the Tencents, the NetEases, even the King.coms have all stepped up to do investment, and they are putting in more money in terms of equity investment than the institutionals did at their 2010-2011 peak. So again, if you look at my previous presentations, I talk about the drivers for that. These guys have to invest in the field because they're in the games business and they want to make sure that they get the next hot game company. So here's some better news. Europe is alone in the Western world in having a cadre of first-round venture investors. That is the ones who do things at the smaller rounds, from a couple of €100,000 to a couple of million euros. These guys have people with games experience, and they make multiple investments. It's not just one. These guys are committed. So London Venture Partners, that'll be speaking here later today, Initial Capital, Sunstone, North Zone. There are many more. But the point is, the U.S., which traditionally has been the leader in venture capital, U.S. game companies are envious of what you have here in Europe. You have an entire ecosystem of people, of seed and seed stage firms that are willing to put money into it. And the reason is that these guys expect tens of exits in the 8 figures, so that's in the tens of millions of euros, to the very low 9-figure range, which fully supports, if you have to put 5 million to work, and then you may have to put 5 million in supporting capital, you can make a great return on 10 million if the company gets sold for $50 to $200 million. Then, in terms of which ones get the next round, when you deliver a top grossing title, a next round is sufficiently de-risked. I'm sorry to use something which is a terrible neologism. It's not really English, but it is what the buyers tend to say. When someone's looking and saying this is a hit-driven business, people want to see whether you're going to have a hit. But once you deliver a hit, it's a lot easier to get money the next time. So for the companies that are not game studios, like the ones who run games as a service, the ones who provide tools and analytics, those guys also can reward $5 million investments. There just aren't as many exits. You may get something like, 10, 20 exits in 2 years of a game in 2 years for game studios. You'll get maybe, I'm just guessing, 5 to 10 for every one of those categories put together. So here are the things that both investments and buyers say. They all start by saying great team. It's a cliche with VCs that we always start with a great team. They look for greenfield opportunities. So by greenfield, that's something new and different. VR was a greenfield opportunity. As you'll hear if you attend the VR financing panel, there have been nearly 300 investments in the VR space, so it's no longer a greenfield. They look for a bluish ocean. For those of you who aren't familiar with that, Harvard Business School did a famous piece a number of years ago describing a highly competed space as a red ocean. So mobile games is a red ocean. There is so much competition for so few top spaces. So VCs like to look in blue oceans because they don't want to be up against a lot of competition where a good company can fail just because there's so many people in it. If you want to see why this makes case, go to China, which is the most hyper-competitive market, where literally there can be several hundred companies competing for the same position. Even if you are a great company, you still have to be lucky. They look for an unfair competitive advantage. So, for example, an unfair competitive advantage is you have the exclusive Star Wars license. Star Wars is an incredibly popular film. You have the exclusive license. That gives you a reason why you will probably get on the charts. Another advantage can be that an unfair advantage is you have the team that did Candy Crush Saga for King. One reason why Tommy Palm got money is not, forget the quality of the stuff he's doing in VR, but Tommy Palm has one of the greatest successes out there. Sustainable unfair competitive advantages are you have the Star Wars license for 5 years. So great game. People say, most VCs say they care about a great game, but very few actually do. Jari Ovaskainen, who was the first investor in Supercell, actually does. And if you see his pattern of he's invested in next games, he always says get the game right. But usually it's the buyers who care about whether you have a great game because they're going to hope to distribute it to their people. Then people invest or buy by the sector, game genre, or territory. Very rarely do people invest in technology that supports for games because that's a sale on a sale. In other words, you could have a great technology, but for those of you in the games business for a while, game people tend to think they can come up with technology in their spare time. They tend to be very hard to persuade. And Dan's smiling because he can think of companies like that. So let's talk about now large M&A. We talked about financing. Let's talk about large M&A. First decision is buy versus build. Are you going to hire up a staff or are you going to go and just buy a company? There's a lot less risk in buying a company because you get a team that's already together. They may be moving forward. Often it's to acquire a studio or back-end capacity. So we need a new studio to make first-person shooters. Let's go and let's see which first-person shooter company is available at a price we're willing to pay. Usually when they're large, they want to enter a new line of games, so they want to be in first-person shooters. And what happened is they missed the market, so they have to buy it defensively. Buying an established product line, pretty obvious. We've seen many transactions like Activision stayed out of mobile, and when they decided to do it, they went in by buying King.com, which had the single most successful mobile game going right now. And I don't know if the phrase Mr. Market translates, but often when you're doing large transactions, usually you're trying to do it so that the stock market will increase your stock price, or because you're getting slammed in your returns and you need to have a story to be able to tell the stock market to arrest the fact that your stock has gone from 20 to 5. Small is a different thing. Buy versus build is usually something like we want to go to a different geography. We're based in Berlin. We've got most of the people who know how to do the type of game we're doing. Now we want to get we want to get a studio in Romania or Shanghai that's going to be cheaper, or we now need something that Berlin just doesn't have, so we're going to have to set up something in London where they do have them. When these guys enter a new line of game business, usually it's complementary. So I'm doing match 3 games. I want to do another type of casual game like puzzle games, which we don't particularly have core competency to do. And then the other issue is, as you'll hear throughout the day, the market is rapidly consolidating. And so what you need to be able to do is even the mid-sized companies now either have to grow or they're going to get swallowed up, and they want to make sure that they are at least an expensive bite for somebody to get. All right. We all read, almost everybody who is in this business makes the mistake of reading the media, reading the business-to-business media regularly, whether it's VentureBeat, whether it's TechCrunch, whether it's Gama Sutra. And there's always that deal, as in, I want one of those deals. The thing where you say, I can't believe those guys got a deal like that. In investments, usually they're around $5 to $7 million, and sometimes they're only put together with a PowerPoint. If you want to worry about why you're not getting it, that way lies madness. There are many, but just go out, get stinking drunk, but don't worry about it because you're not going to. It's a matter of luck and timing. Usually those deals are a team that has got good credentials. So they worked on Clash of Clans, they worked on Candy Crush Saga, they worked on Call of Duty. And usually they have not worked together independently. And this is one of the perverse things that happens with buyers. If a company has been around for a year and has not delivered a hit, all of a sudden they get pegged as a company that can't do it. But when you've never worked together before, but you have good credentials, then people can project that you can have $1 billion game. It is a bit of human psychology that if you look at most of those deals, which were done on PowerPoints and where people got somewhere a lot of money, it was a team that had never worked together before, or They are the new company from someone who had a success before. So an acquisition, it's just the stars aligning. Again, there's nothing you can do about this. The buyer is a new entrant to the field, so Leo Kirch wants to get into the games field because all the other German media companies are into it, and they make an acquisition. They've decided it's a game company. They decided that they have to get into VR, so they buy a VR studio. The phrase "it's better to be lucky than to be good" has occurred to people. My longtime colleague Greg Kostikian, who is one of the most talented designers in this field, once said to me about 15 years ago, "I'm tired of being good. Can we just get lucky right now?" Unfortunately, I then suggested to him that he go out and have the drinks that I recommended to you because it wasn't going to happen on any particular schedule. All right, let's talk about how these guys value things. So any professional investor, and that means anyone who has any sense of what's actually going on, rather than dentists or somebody like that who just have no experience of the field, will allow for the company insiders to retain 50% after the second financing. Unless the only way that you should be looking at the company founders, and that by the way includes the staff, is if you've really screwed up on the first round and you're getting a second chance. The greatest investment variable is whether to invest in the first place. They're driven by exit prospects. So as I said, later stage they're dealing with the low multiples, and at the earlier stage, the good news is that they think the prices can go up by 10 to 20x. There's much more room for growth as a multiple over there. Strategics, strategics are willing to give you better valuations if you're willing to give them a first look or distribution rights. The problem is that makes it hard to sell to anybody else, because if you make a deal with Gameforge and you give them the right to buy you first, then that's going to be hard. That's going to be hard to convince somebody else to buy you. For buying, they want to give you a lower base price, that is the guaranteed money, versus earnout, which is in your performance, usually in the first 2 to 4 years after you get bought. Venture investors are a minus for buyers for the very simple reason that they have to hit a return number rather than necessarily what the company is actually worth, because the venture investors are telling their investors, the limited partners, that they'll produce 100% return or whatever it is. Buy versus build versus rent we discussed. So the smaller the acquisition price or the investment, the more value is given for the team. The more expensive you get, once you get to 100 or 200 million, then they care about your revenues more than the quality of the team. And there's a sharp divide, and this really is almost a religious war among the buyers, between games that are at a peak, like Candy Crush Saga, so therefore there isn't much opportunity for growth, and whether or not you shouldn't buy at peak because you're going to be overpaying. There are two sides of the camp. You will get 10 companies that will see one way and 10 companies that will go the other. So, just to summarize, here's the good news. For mergers and acquisitions, the games industry is in a consolidation phase. That means people are buying. And as you'll hear from Paul, if you attend Paul Gardner's session tomorrow morning, where he projects that there will be a wave of M&A in Europe for the next 3 to 18 months, the good news is, if you have a plausible company, there is a window of opportunity in which to sell it in Europe from, by the way, it may not be exactly from May of 2016 to November of 2017, but it's somewhere around that period. The other thing that Europe has, if you are early stage and starting, is you have a combination of those first round VCs mentioned, but you also have a terrific super angel community. We have a super angel panel coming up. We have a top Dutch investor, a top British investor, a top Finnish investor, and a top German investor speaking later today. The interesting thing about them is every one of them has been with two of the others together. They cooperate. In the U.S., where I come from, we would kill for that. We just don't have it. The two major super angels have gotten out of the business. Rick Thompson, who made a couple of successful investments, including an exit with me, is staying away from games. His firm writes things about games are no longer interesting. So you Europeans, anyone who's, assuming everyone in this room is in Europe, you have a wonderful start. You can finally tell the U.S. you're our poorer cousins when it comes to getting investment capital for games. But the not so good news, the games industry is in a consolidation phase. As a result, from the point of view of an investor, the problem is that the prices are pretty much determined. There's a band in which the buyers will pay. So the prospects for huge returns like Supercell and King.com have largely passed. And then the other thing is it's long odds against. That is, the odds are pretty poor unless you've carved out a successful niche, unless you've found something that you can prove that measurably you do better. Not that you just have a great idea, but there is some objective proof that you're able to do that. And the other way, of course, is when, as I mentioned at the beginning of this presentation, buyers or investors come looking for you. Anyway, I will take, do we have time for a few minutes of questions? Or no?
We have, I think we have time for one question. Go ahead and raise your hand if anyone has a question here.
Sorry, I did not be there on time. I was 5 minutes late, but so I'm not aware that how familiar about the Finnish government system, that how we support game companies and investments in Finland, because you mentioned that government doesn't really think that game industry is eligible to get funded by government. In Finland, we had this technology innovation.
Oh, no, I'm sorry, you misunderstood.
Oh, okay.
Okay, first off, Finland is a completely different ecosystem. Finland is to games what Silicon Valley is to technology. You guys have an awesome, it is the best thing you can be in the Western world is a Finnish mobile game developer, because if you look at Ilkka and Mikko, the two founders of Supercell have between them made 25 investments in companies. There's Rovio, there's Sulaki, there's Remedy. This is a nation of 5 million, and if you are an elk who knows what a mobile game is, you can get money over there. The government seeded it fairly extensively. Oh no, I didn't cover the Finns because there are 370 million Europeans, so 365 million people. You've now really pissed off the other 365 million people by telling all the benefits that you have.
Okay. I close my mouth.
And with
but
that,
you're a very lucky man, is all I'll say.
And with that, I'd like to thank Eric Goldberg. Thank you so much for coming and putting on this great